Hey everyone, my name's Andy. My channel's Finding Value. I was looking at, the ratios, and the ratio for oil for natural gas is extremely cheap. Now, someone posted this in the comment section about rig count because someone had asked me, what's the rig count look like? Is it super low? And I said, well, in the ratio is going to say yes. I don't even need to look at the rig counts. But someone posted this, and this is the rig count. The rig count says the number of active U.S. crude oil and natural gas rigs is at the lowest point on record. And it has to be because if you have the lowest ratio, it means that your demand has gotten destroyed, which is going to destroy your supply. That's why your ratio is so low. But we're at 339 rigs. It looks like at the top of the peak is over 2,000 in 2008. Producers were operating the fewest oil and natural gas drilling rigs on record in the United States at 339 on May 12th, the lowest level in the Baker Hughes Company's rig count data series that dates back to 1987. So they are way down. The number of rigs taken out of service were in the top 3 U.S. crude oil producing regions: the Permian region in southeastern New Mexico and western Texas, the Eagle Ford region in southern Texas, and the Bakken region in Montana and North Dakota. Rig counts have also fallen in natural gas focus plays, although those plays hit fewer rigs. Earlier this year, the top natural gas producing regions produced natural gas. So this has also, look at this, just fallen off a cliff. This was up around total rigs of about 2,000 up here, and we are way down. It's like asymptotically approaching, well actually that's not even asymptotic, that's just straight going down to zero, beelining. Changes in the number of oil rigs have historically followed changes in oil prices with a lag time of about 4 months. However, the current drop in rig count followed the recent decrease in oil price much more rapidly than in the past. The spot price of West Texas Intermediate began March 2020, $46.78 per barrel, and ended the month at $20. Most of the decrease occurred in the first half of the month. The rig count began to decrease sharply in mid-March. The quick reduction in active rigs reflect the sudden loss of petroleum demand related to coronavirus-related mitigation efforts that also resulted in recent increases in the amount of crude oil placed in storage. So these things are declining. They're not. What's going to happen is a bunch of supply is going to come off the market. When that supply comes off the market, it's going to firm up prices. Prices will eventually go higher because we're not producing oil. Again, I think what's going to happen is it's going to be the winter could be kind of rough because people are staying home. We could have some more, we'll call it stay-at-home orders for states, and coronavirus, COVID, it's going to go higher. More people are going to contract it, so we're going to be less likely to be moving around. And then I think next summer, hopefully this stuff kind of blows over a little bit and declines in its penetration out there, especially over the summer, and hopefully even next winter. That's when demand will start really picking up. And if we can start moving around again, that just means more demand. So I just wanted to share this. If you guys like this content, please subscribe, leave comments, and click the thumbs up button. Thank you.